Good morning, my name is Dr Przemysław Kwiecień, I'm Chief Economist of the XTB and you are watching our weekly trading webinar. Today we are going to discuss mostly the US dollar and we'll wonder whether good levels that we are looking at on the greenback, is it going to persist, or the weakness going to persist, or are these levels presenting a good opportunity for a turnaround. So let's start traditionally from the top news that we have on Monday morning. So I guess the biggest news is what I point out as the last point, which are the moves on the crypto market. Last week we had a big crash on the cryptocurrencies, and it's all related to China. First of all, China made it impossible for financial institutions to deal with anything that is related to cryptocurrency, and right now they are increasing regulation on Bitcoin mining. About 70% of Bitcoin mining is done in China, and since it's consuming a lot of energy and China is moving towards being more balanced and green in this regard, that's the biggest reason for a change. And that's the reason why we had another serious pressure on the crypto market during the weekends. And we'll discuss this in a minute. Meanwhile, markets remain upbeat. It shows that at least right now, the crypto thing doesn't really affect the broader markets. The indices remain very high, tech rebounds, and all those good news, all those good upbeat sentiment, despite the bad news of price pressures that we are seeing pretty much everywhere. Gold rallies on weak US dollar, stable treasuries. That's the key reason. We'll discuss that in a minute. Why are treasuries where they are, despite what we are seeing, and what you can read on the right, that even though we are looking at a strong rebound in US and Europe, we are also looking at unprecedented price pressures that should push bond yields upwards, and that should have serious ramifications for the markets, but this is not what we see. So this is going to be the biggest thing that we are going to discuss in story of the week. But let's start from previous week. And yeah, I already mentioned this crypto crash and PMI indices. So let's start with the crypto thing. And you can see here a chart where I simulated crypto prices, rebasing them to the Bitcoin high of 2017. So as you can see, this is one. I rebased this to one. Blue line is a Bitcoin price. Orange is index composed of 40% of Ethereum and 20% of each of Litecoin, Ripple, and Bitcoin Cash. As you can see, these major alts, as I call them, they rallied more than 100% from the point where Bitcoin topped in 2017. So this situation is actually quite similar to what we saw this time around. So Bitcoin topped in early April, and since then, within a few weeks, the alts, which were here at that point, they rallied, okay, less, it's 60% to 110% back then, but still they managed to rally a lot when Bitcoin was already struggling. So what's the point here? I mean, these are obviously only two observations, and there are many factors that can influence the crypto market in the future. However, if you can see here, the Bitcoin's demise here was actually a bad omen for the whole market. So even though we had this rally on the alts, that eventually faded, and pretty much the alts, they got rid of all this advantage against Bitcoin within a few months. So obviously it doesn't need to repeat. However, right now there is a similarity, and with this push from the China side on Bitcoin mining, it's going to be interesting to see. If Bitcoin continues struggling, then we can see all this hype around the whole market vanish as well. It's going to be definitely one thing that is interesting to see, especially with more tech, US tech being involved. To me, it's mostly that it was fashionable to use cryptocurrencies, and I think more and more companies realize they need to at least talk about it. They need to be a part of it, to support their valuations. And now with this wave fading, that could affect these companies more than it did 3 years ago, but that remains to be seen. All right, the second story is the PMIs from Europe, and as I said, the biggest thing is the price pressure. As you can see here, the price pressure in Europe is much higher than ever been, even back to 2011, when commodity prices were increasing at similar pace as they are doing right now. The price pressure overall was much more muted than what we are seeing here. So yeah, it's really going to be interesting to see how it plays out, because now we are moving to the story of the week, which the price pressure is a part of the puzzle. Why is the US dollar so weak, and treasury yields, why are they stagnant when this price pressure should be causing a rise, and pretty serious rise, in bond yields in the US and globally, and should drive the dollar higher? So first of all, let's start with the US dollar index, which once again hovers around the 90 level, and pretty much the dollar, shed all the gains that it had in February and March. And as you can see here, there is some kind of similarity to 2018, when we were after a long period of oversold dollar by speculators. This is COT data, which you can have on your platform. If you type FX and then COT, then you can have on several instruments, you can have this data on positioning. As you can see here, this positioning of speculators remains low when it comes to US dollar. It's not as low as it was, but here you can see it was a long period of oversold dollar, and then the dollar started to really gain. The main message is that should there be, it's the pure fact of being oversold doesn't mean it goes up automatically. Obviously, as you can see, it can last many months, but if there is a good reason, then this oversold position can increase the pace of the move in the opposite direction. Then now, of course, there is a question: will there be the trigger? First of all, if we look at the macroeconomic data, there is a good reason to believe that the US dollar should be outperforming. On the left, you can see inflation rebased to beginning of 2020, and as you can see, in US, prices initially collapsed during the height of the crisis, but then really took off and continued to move up rapidly. So if you compare that, for instance, to UK, it's moving much faster. In Germany, it's at similar level compared to the beginning of 2020, but as you can see, that there was never a similar tanking. So if we rebase the data to, let's say, March, April, May, then obviously this dynamic in the US is the fastest one. Also, the demand is strongest, as you can see here, again rebasing to the beginning of 2020. In the US, we are already way above the level from the beginning of 2020, which I showed last week. So strong demand, high input costs, that this is a mix that is favorable for creating inflation, and that should normally support the currency, in this case US dollar. The reason it's not really working that way right now is that the bond yields are kept stable in the US. As you can see here, the difference between bond yields in Europe and the US was moving in favor of the US dollar in February and March, the period when the currency gained. But then US yields, the red line, they remained stable, whereas German yields started recovering on this economic rebound, and therefore the euro dollar rebounded even more actually than the yields differential. But that's the main reason. So the conclusion is pretty obvious. If you want to see stronger dollar, you need to see higher bond yields in the US. And that's not gonna happen for as long as there is too much money on the market. And the too much money is not really the effect of QE. Obviously, it contributes to it, but of what I was discussing on a few occasions last 2 months, when I said the Treasury did awkward operation of dropping a lot of their cash position on the market, even though they will need to borrow even more in the future. But right now, they dropped a lot of cash on the market, causing equity indices to rise, causing gold to rebound, causing US dollar weakness, because and this can be tracked under this link. As you can see here, the Fed needs to sterilize some of this liquidity with reverse repo operations. Otherwise, short-term rates in the US would become negative. So for as long as this is high, there is no reason for bonds yields to increase, because investors are pretty much looking for any opportunity to park their cash for as long as there is too much of it on the market. It should change around the summer. This is a chart, I think I showed it last week, where bond placements, the yellow bars, will be much higher than the QE. Right now they are already higher, but the difference is not huge. But you know, as the time progresses, the US Treasury, as they already dropped a lot of cash on the market, their cash position is lower, and they will need to borrow more in order to finance huge US deficit. So this should withdraw this over liquidity from the market, and that should push bond yields higher and therefore help the US dollar. So obviously we are saying about the summer, and it's quite possible that until that time US dollar will become weak, but you know, with the markets you never know. For sure, if you look at the levels right now, they already on some dollar pairs look nice. The US dollar index is around 90 area, and also looking at some emerging market currencies like USD PLN or USD ZAR or USD MXN, I have it here, they're already at strong support levels, and therefore the balance of risk looks favorable to the dollar, at least in the medium term. In the short term, as I said, for as long as there's this over liquidity on the markets, then the dollar could remain weak. It will have also the impact on the other markets. One of those markets that is strongly affected is gold. This rally continues, and it's looking good right now. And again, here investors should be watching bond prices. If bond yields starts to rise, then bond prices will decline, and that will be a signal that this rally probably is over, at least for some time. But right now it doesn't happen. As you can see, despite all the inflation story, these bond prices are still very stable, so that supports the rally on gold. Also, the US Nasdaq took advantage of these low bond yields. This is the index that is most let's say prone to any changes in bond yields, and as you can see, last week we had this kind of double bottom here, and if you look at what happened in the past, we had some corrections which ended with these two double bottoms, the second one being the lower one. It happened here, it happened here, and once again it happened here. So technically this chart actually looks quite bullish, and that's going to be the case for as long as the yield situation, bond market situation remains stable. All right, the week ahead is fairly benign, I would say. We have some releases, but not huge ones. We had conference board tomorrow, RBNZ decision Wednesday, claim second release of US GDP on Thursday, And then probably on Friday the most relevant data, which is French CPI inflation for May. Normally markets do not pay too much attention to French data, to be honest, but this is the first European release for May, so the next month. So this is why I made it in bold. And PC inflation in US. So PC is the one that the Fed looks at. Of course, we already know the CPI inflation, which was much higher than expected in US. So the PC will go up as well, but it's still for April. So it's not the big news that we have when the CPI is being released. All right, ladies and gentlemen, so that's it for today. Have a good week. Stay with us with web platform tracking the news section, and the same thing with the mobile XTB trading platform. You have all the news from Monday to Friday all the time on the major market developments. So stay with us, and we'll see each other next Monday at 7:30.